Leading a financial service firm requires a distinct approach to strategy and leadership. That's why Harvard Business School Executive Education offers a 5-day in-person program focused on leading professional service firms. In this program, participants like you will explore topics such as corporate culture, retaining talent, and communicating a strategy and vision. By the end of the program, participants will gain frameworks to lead change while preserving client satisfaction. Explore the program at hbs.me/client. That's hbs.me/client. Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. Today we're welcoming to the podcast Ted Mortonson. Ted is a managing director and technology specialist at Baird. He has over 30 years of investment industry experience. Ted, welcome to today's podcast.
My pleasure.
Ted, as we exit earnings season, can you share with us key takeaways for the technology sector?
Well, number one, this AI spend is historic. With the big cloud titans, you've now got spending in the $720 billion range, and that's up 73%. So right now, we've got a massive, massive pull-in of infrastructure and semis. In fact, the semi index is up almost at the peak, it was up 58% in 6 weeks. So I think what you're seeing is this major infrastructure build that's happening in the US and China and essentially not happening in Europe for various reasons. So AI is inflecting. It is inflecting now on inference, and we're out of I would say, the experimental phase and actually into the deployment phase.
So, from a baseball analogy perspective, what inning are we in for the spend, do you think?
I think, well, we're probably in the first or second inning. This is going to go for years. And, I would say a pretty easy guess would be the next 5 years. Some people think it's going to be a decade of spend. I think we're going to run into some capacity, overcapacity issues probably in about 5 years.
And post earnings, what's the tone of conversations you're having with institutional allocators today regarding technology exposure? Obviously, there's a lot of market concentration in this sector. What are you hearing from investors?
We're really playing chess on four levels now, and the macro is very hard to predict. It depends what President Trump says on a day-to-day basis with the Iranian war. So that's one. Number two is there's inflation in tech everywhere, whether it be substrates to memory to lead times going up because of the magnitude of this build. The institutional investors are getting a little bit leery of where the 10-year treasury is trading at. I think it was 460-ish at the beginning of the day. And the reason why is just multiple contraction. We haven't lived in a stagflation environment since the early 1982, and a lot of people don't have that trade. If it really gets out of hand on the inflation front, tech, which has been the darling, may not be a darling in that environment.
And Ted, from a historical perspective, given your tenure in the investment space, in the technology space, anything that feels different about that cycle? You often hear people quoting saying this time is different.
It is different. I lived through the 2000 cycle, and I think that's the first cycle that was a melt up cycle, and we were valuing companies based on I would say non-traditional valuation themes, whether it be eyeballs or net new ads, and a lot of the companies weren't profitable. This cycle is totally different, where it not only does it have multi-years of legs because of the technology shift and the potential productivities that gains it will have not only in the general economy but in the defense industry. This is really a game changer, and I run multiple agents right now on agentic, and I can only tell you what I would utilize a team of 20. I don't need a team of 20 anymore. I probably need a team of two or three.
And despite the strength of the stock performance here, is it possible that there's still aspects of the technology sector that are not fully appreciated or fully understood by investors at this point, or is it all sort of out there?
I think the majority of it is out there. There's new technology trends that are starting to be realized in these next generation data center. NVIDIA, which reports tonight, is really the pioneer of pushing architecture to new levels. For example, the proliferation away from copper to optical is one. The proliferation of higher power into these data centers, 40 volts going to 800 volts. Um, and I think that architectural shift is much different and it's really leading bleeding edge. And where the flip of the coin is can we get through the complexity of it? I don't care if you're talking to Amazon, Google, Microsoft, or Meta, they're running into the same issues on complexity. This is one of the biggest case studies of compute, next generation compute that anybody has ever seen. So we're really in uncharted territory.
And we're also obviously at the midpoint of the year. In your mind, what have been the notable surprises so far this year?
Number one, how fast lead times have increased. And I don't want to say that we're going into a COVID golden screw issue, but lead times were for semiconductors were, 18 to 20 weeks. Now, in some cases, they're out 52 weeks. So the magnitude of demand has been staggering. That's number one. Number two, the ability of the market to actually finance, a lot of this hyper growth has been really pretty amazing to see. And that's not only the cloud titans putting their own equity in, but more importantly, whether it be private equity or project finance or now the IPO market, the amount of capital that is willing to deploy into this sector is pretty staggering.
And given that as a backdrop, what do you think the surprise could there be areas of surprise in the second half of this year? Things that could be
Yeah.
upside here?
I think one is power. I'm in the US, power availability, the easy power on all these huge data centers that are city blocks long and big, million plus square feet of data center. The easy power hookups have been made. And I think if you look at Elon Musk's Colossus 2 in Memphis, they were probably one of the last huge data centers to get through the window, but it was incredibly difficult for them to get utility power. And I think where the mismatch is not silicon availability, it's going to be power. We're going to be talking about power for a long time in the US. China doesn't have that problem. They've built a tremendous amount of nuclear facilities as well as solar, and they're sitting on a lot of power capacity. Europe's in trouble. They have 200-year-old infrastructure that they're seeing cancellations of data center because they can't get power. The other thing I think that nobody's thinking through, and this is the second half, is really the political potential headwinds that the Democratic Party will use this as a wedge issue, going after the tech oligarchs like a Jensen from NVIDIA or a Michael Dell or anybody that has really done extremely well from a technology standpoint. I think they're listening to their constituents on utility prices and data centers not in my backyard, and that is not in the market right now. So let's just assume that President Trump loses both Congress and the Senate. You already have Bernie Sanders and AOC out there on almost a vindictive drive against any kind of new data center. I think we have to watch the political backdrop closely after November.
And what does that mean for portfolio positioning? Is there
Oh.
moves that investors should be making today to sort of strike some kind of balance for those things that may or may not happen?
I think you just have to highlight what those issues are, whether it be power availability, silicon supply, or the geopolitical. The straits have been closed now for almost 2 months. Um, it could get pretty ugly, depending on what President Trump does in the Middle East. And then that political, you just have to put them on a piece of paper and see if they materialize. And if they do materialize, you've got to react. You're not going to be able to run or, assume some of the same scenarios of unlimited growth. If you ever looked at the Gartner curve, you have this huge run up on kind of the hype cycle, and then at the peak you roll over into what's called actualization, and then the cycle turns up after all the bad news is in the names. I think we may be kind of approaching the Gartner hype cycle a little bit. You just have to understand where those four headwinds may materialize. And if they do materialize, you've got to react.
And you touched on geopolitical as one macro factor, inflation, interest rates, capex. If investors look at the macro, what are some of the areas they should think about when looking at the technology sector?
Well, I used to fly for the Navy, did for 12 years and did three full deployments in the areas that are hotspots right now. I don't think there's an appreciation on Wall Street of the geopolitical. It's not in any of the algos. It's not in the market. And I think when you really sit down and do an analysis of the Straits and the Red Sea, roughly 20% of the petroleum input comes through the Straits of Hormuz, and that does affect actually semiconductors from helium supply to neon to bromide. The cost of materials or commodities is only going up. Let's just say the macro turns south and we're really in a prolonged shooting war where it actually moves to the Middle East and other areas. That supply chain is so delicate right now that if we do get a headwind on supply chain and transportation or commodity transport or manufacturing is impacted, we're going to have even a worse scenario for inflation than we do right now. That's number one. Rates, we're sitting on $40 trillion of debt. And I think the US not only has a problem, but look what's happening in the UK and Europe. The diversified tech portfolios right now, if you look at the diversified tech names, they have roughly 30% of EU exposure. If the EU goes into recession or even worse, those models are incredibly stale. Also, if you do have inflation that is really negative for emerging markets, that's about 10% of the diversified tech holdings. Those models could be getting a double whammy in 27. And I think you really have to look at where growth may come on the elasticity of demand on inflation. We're already seeing the inflation hit specific consumer segments like handsets or PCs. That elasticity of demand is down almost 10 to 12% on units just because of the cost of memory.
And shifting to themes, we've obviously artificial intelligence, really big theme. Are there other investable or compelling themes out there that investors should be aware of?
I think there's a couple areas. One is we don't have enough supply. So the semi-cap equipment names, I sit on 70 plus conference calls during an earnings season. And one of the most interesting calls of this Q1 earnings season was AMAT, where Applied Materials is really the kind of the call option for all semi-cap equipment worldwide. They're the biggest company. It's the first time in my 30-year career of doing tech that I've listened to a CEO being so bullish and raising his growth rate from 20 to 30%, not for 26, but for years. So we have a supply issue that the semi-cap equipment names have got to solve, and you're looking at 3 to 5 years. A fab doesn't get built for 2 years, especially on memory. Because of this demand, we've got a long time to meet supply. So semi-cap equipment, I think it's much more investable over the long term than it is historically has been. A wafer fab equipment or WFE, I think is really going substantially higher in historical levels. The other area is one of foundries, and there are only four huge foundries in the world. One is TSM, the other one is Intel, the third one is Samsung, and I would put Global Foundries as a lagging fab. Those fabs on the leading edge are at capacity. So we also have a manufacturing problem. The other structural issues that I'm seeing on the new data centers is this move to optical. Optical historically has been a cyclical industry. Now it's 100% secular. For the next, you talk about an innings of the baseball game, the transition from copper, and this is just physics, the distance that copper can go on signal integrity is relatively small. This is why NVIDIA is transitioning all of their next generation product to optical. It's called CPO. If I give the baseball analogy, the grounds crew have not even got to the baseball field yet, and the lights are off. Optical could go for a 5 to 10 year run here. And it's reflected in a lot of the names. There isn't a lot of names you can play in optical, but I think optical and memory are structural segments of the architecture that are changing and are evolving very, very quickly.
And now a word from our sponsor. If you lead or advise at a financial services firm, this may be something to keep on your radar or to share with a colleague. Harvard Business School offers leading professional service firms a 5-day in-person program for working executives to explore topics like corporate culture, talent retention, and how to deliver consistent client value. Held on the HBS campus in Boston, this program focuses on leadership and strategy by working through real challenges at professional service organizations. You'll build a global network across industries and engage directly with HBS faculty. To learn more, visit hbs.me/client. That's hbs.me/client. And Ted, back on artificial intelligence, are there particular metrics at this point, or is it too early to determine whether AI spending will translate into acceptable, sustainable investment returns for the companies that are deploying it?
Yeah, I think there has been some massive breakthroughs, and I'm trained to be a skeptic and trust and verify, as a old Ronald Reagan term would have. Um, I am amazed upon how the breakthroughs from Anthropic and OpenAI with their new models is changing the next generation knowledge worker. And what I mean by that is productivity is now inflecting in a huge way. So the way you look at AI right now is, I think you really have to pivot to inference. Google yesterday at their developer day basically said in 1 year their inference growth is up 7x year over year. So I think you have to look at token growth, which is tied to inference. You have to look at the enterprise spend that is now going into what's called agentic AI. These are the agents. And then you have to kind of look at the older architectures like software as a service. Those have been obliterated. The IGV is down 13%. A lot of the software stocks that are legacy are down even more, 35 to 40%. I think you have to look at the models and see that transition actually materialize to get a real feel if AI is lifting off.
And what you've described so far, it sounds like very pervasive, broad impact on the economy. I'm just wondering, in your own mind, are there particular sectors or business models in the near term, being the next year or two, that you think are going to be early beneficiaries
Sure.
of artificial
I,
intelligence?
yes. I think you always have to start with the financial vertical because they're sitting on most of the capital. Think about Goldman, Morgan Stanley, JP Morgan. They have been working on this AI thought process for the last 3 to 4 years, and now they're deploying. So I think you have to look at not only how they process loans, how they look at portfolios, health, but also from a headcount standpoint, the potential lift in operating margins in the financial vertical are dynamic. The second one I would say AI is affecting is healthcare, specifically on the pharma and the biotech side. We now can look at drug discovery in months versus years or decades, and the amount of compute being thrown at next generation formularies and drugs is really eye-opening. We're unlocking Aladdin's lamp on new drugs at a pace that I don't think the world has ever seen before. So I would say the financial and industrial, or the healthcare and the financial verticals are first. The third vertical most likely will be in industrial automation, and this is we're already starting to see it right now on what's called digital twin technology on factory construction, but also optimization of robotics. And robotics is probably one of the biggest total addressable markets that hasn't materialized, that in 5 years could change the way manufacturing and, quite frankly, us as from a consumer standpoint are using robotic-like technology to make our lives easier.
What about for artificial intelligence? What role is that playing in the trading today? And is the potential there to create more volatility in the market?
Yes. The human element, 20 years ago, you'd have a market maker controlling volumes and kind of settling down both the buy and the sell side and coming into some person in the middle. Right now, this is being driven by machines, and I can move a stock on 50,000 shares, 3 to 5%. That wasn't the old world. And I think if you have one of these really ugly events, right now everybody is in the pool. If you have a lightning storm and a lightning bolt strikes the pool, everybody's going to be running at the same time, and there's going to be no price discovery. So that's why these moves, both positive and negatives, are so extrapolated. And this whole mentality of trading 0-day options on retail, I mean, I think the whole retail trade at some point is going to end in tears because, in essence, from an experience level, understanding the fundamentals, they're taking a knife to a gunfight. So I would say from a retail perspective, they really need to get good counsel and not play this as a casino, because in essence, the casino always wins and retail will lose. Well, my worry right now is retail's buying at the top and they have no idea what they're doing. So it's kind of hard to watch.
And shifting into portfolio construction, if you were going to construct a portfolio today, at least from a sector perspective, how would you think about allocation? You touched on software, semiconductors, there's hyperscalers, there's cybersecurity. Can you give us a sense of some kind of priority order as to how you might weight a portfolio?
I think you have to be overweighted semis, even though the semiconductor index is flying. The demand versus supply and the pricing that we're seeing on the increasing on silicon is still pretty robust. So that would be number one. Number two, you mentioned security, and I think there was one event that happened about 3 weeks ago, and that's through Entropic's Mythos model, where it's the first time I've ever seen an impromptu meeting between the head of the Treasury, Bassett, and Jerome Powell from the Fed, an emergency meeting on a Friday, and they formulated a working group called Glasswing. And Glasswing, what this Mythos model could do, it could look at any code, let's say over a decade, and highlight the code that could be hacked. So this is technology that I would say the CIA has had for years on the AI, looking at what can be hacked and whatever. Now it's mainstream through Anthropic and OpenAI models. So the whole security backdrop is changing. It's changing. It's changing to AI related security. And if you look at the charts of CrowdStrike, CRWD, and Palo Alto, PANW, they just got dropped a new total addressable market in their lap on looking at legacy code and trying to patch it through AI security. But more importantly, security is changing. It's all going to be AI. I don't know why people actually order firewalls anymore because you can assume the bad guys are in your network anyhow. I think we're transitioning to more of a zero trust AI infrastructure for security. That would be number two or three. Two. The third one I would say is just the proliferation of next generation software. Um, right now, that deployment of next generation software, which will be consumption based, not renting software like SaaS, the new names like a Snowflake or a MongoDB or a Datadog. Datadog just absolutely annihilated the quarter 2 weeks ago because of complexity in this AI infrastructure. They do observability. Software is changing. It's going to be priced on performance and how much you use. So those names that are consumption-based models, that's where I have the interest. I don't have very much interest in the old legacy SaaS names. So we're going to see a whole new crop of software names. I'd highlight Palantir also. There's been a lot of consternation about Anthropic putting the hurt on Palo Alto, which I think is kind of ridiculous, to be honest with you. Um, I know Palo Alto from, I know Palantir from the days on defense, but they're moving into enterprise. And here's a company that has 8 billion in cash and free cash flows, like, I mean, just immense amounts of free cash flow. They are taking these huge data sets for the global 2000 and actually converting them for decision making. It's those new type of software names. Some we don't know. Some are kind of behind the curtain right now. Some we do know. And I think you're going to see some unbelievable IPOs, whether it be Anthropic or Databricks or OpenAI, that will show you to the new, and they will give you a huge valuation upside. So I would say next generation software would be number three.
And obviously, within the S&P, at least, S&P at least, as far as a benchmark, technology has a huge weighting. And we
Mhm.
started the conversation, you're talking about early innings of the trend. What do you think that means for portfolio managers out there that need to at least keep up with the index? Oh, and because we're so early, has this fundamentally changed how, institutional investors need to manage money to at least keep up with or beat the index that they need to have significant exposure in this area?
They're going to have to quell their portfolios. I mean, when we're talking about a SpaceX IPO that's in the trillions and being raising, called $100 billion. These are huge tech companies. And I think where the portfolio managers, through my conversations with them, has been very simplistic. I mean, they're going to be forced to sell some of their winners to make room for these 5 or 10 key tech names that really do play into the new, that have growth rates and call it 40 to 70%. Those reweightings of those next generation companies, they're going to be a much bigger part of the index. And I think it's clear that some of the tech companies that are, I would view as quote unquote feature companies versus platform, those are the ones that are going to suffer dramatically. I mean, I think the portfolio managers are going to be forced on attribution to play the new.
And does that weigh on the sector for a period of time as some of these very large offerings come out there?
I think you're going to have these outside weightings like you have on Nvidia and Broadcom right now. There's going to be 10 other names that have weightings that are very, very high. It's going to be the have and the have nots. So I would say there may be some really, really good companies like a ServiceNow or a CRM, uh, because they have legacy models. I think some of the portfolio managers are going to have to make a choice on what they're playing. And at the end of the day, it's all about attribution. Well, what I mean by attribution, it's what sectors are going up the fastest. So I give you an analogy. This year, I have portfolio managers that have lost their year. And what I mean by that is they, at the beginning of January 1st of this year, they own too much software. And at the bottom, the IGV index, which is a software index, was down almost 30% year to date, with 2 or 3 months just starting the year. Meanwhile, semiconductors were up 25 to 40%. That delta in performance can kill a portfolio manager, and actually he can lose his 1, 3, and 5 year performance if he's really weighted wrong on attribution, what is contributing to his portfolio performance or what the drags are. And I think that lesson learned in the first 3 months of this year is now front and center. It's an invisible tattoo on every single portfolio manager's forehead, that unless they move to the new, they could be at risk of underperforming for multiple years.
And moving into the actual company level, when you look at the companies that are out there, what distinguishes in your mind durable competitive advantage versus others, where some may have a much bigger runway for that?
Um, being a CFA-oriented model company, or teaching people the way to model, it's not only number one, it's scale. Number two, it's management at the C-level suite that are actually technologists. What I'm worried about with a lot of the companies is the management teams that are making a lot of money, that are in their, call it, early 60s to and older. They do not have the technology background or the acumen to navigate their companies. That's number one. You need really bleeding edge technologists at the C-level suite. Number two, it's scale. Number three, it's engineering, the people, more engineers versus anything else. And the most important thing, where if you look at the cloud titans, whether it be Meta, Google, Microsoft, uh, and to a lesser degree, Amazon, it's all about free cash flow. So you need free cash flow on your existing business to make the pivot to the new.
And from a risk perspective, you touched on geopolitical. What are the other risks that are out there that could raise their heads in the course of the next 6 to 12 months that could cause a pullback?
I think if one party gets into power, I'm not a Democrat, I'm not a Republican, I'm an American. So, but the Republicans are very pro-business. The Democrats seem not to be pro-business at all. If you get a shift in leadership, I think that's one. Number two is I don't think that we are very myopically focused on just the US, on the US markets. It's much more defined now. This is a global market. And there's a realignment on, I would say, global trade. I That has a double-edged sword. If you bring everything back to the US, not only does that create political friction, but it also may lead to military confrontation. Look at China, Taiwan. Look at what Russia's doing in Ukraine, and look at the Middle East. We're in a very unstable geopolitical environment, and it is not reflected in this market at all.
Ted, we've touched on a lot of issues here: earnings, themes, portfolio construction, and now risk management. When you step back from all of this for the balance of the year, what's the playbook that investors should work with as far as investing in the technology space?
I think the number one thing that everybody's challenged with is getting in phase. And this is much more of a transactional market than I have ever seen in my career. Your viewers have to understand that, and this is going against all of the, financial pundits out there, is you have to buy from the fearful and sell to the needy. It is much more transactional. The other thing is sell it when you can, not when you have to. And that's getting in phase. So a perfect example in the near term, in the last 2 weeks, when I have the semiconductor index up, call it 52% in 6 weeks, my clients are selling. They're selling to the needy. Um, they have made 100% in some of these names in, call it, 2 months. You just got to get in phase and don't be greedy and lock in some gains, even if there's a tax consequence. So getting in phase is very, very important. Number two is, I think, um, you know, when we have these kind of, like even today, a momentum trade, my clients are not buying here. When the market's up 150 basis points or 1.5%, they're actually selling names that are up 13, 14%. That's getting in phase. The only time I see my institutional clients buying is when there's blood in the street. And they go back to their core macros and see the mispricing of securities. And the reason why they're being mispriced is because the ETFs now control roughly, call it 80% of the trade volume. It's very hard to put any kind of rationale. The markets, to some degree, have turned into a casino. The NASDAQ probably should be renamed DraftKings or Hard Rock because it's almost a gambling vehicle on, I call it the doctor and lawyers trading between appointments. It's gotten kind of ridiculous versus fundamentals. And I think you just have to be aware that the markets are very frothy, and every single market has these phases. One is complacency, one is speculation and over exuberance. That's where we are. In 2000, when I lived through the markets, we are going through fear, panic, and capitulation, where people are losing everything. There is no cycle experience left. And I think you have to go into every day with some humility and understand that you could be down 40%. And it's going to happen much quicker if we get a trigger that we're not looking for around the corner. You could be down 40% in a week and a half. And I think you have to make sure that you understand the positives and the negatives. And when the negatives transpire, the buy and hold strategy in this market, I don't think works.
Ted, thank you for joining us today, sharing your perspectives and valuable insights. And to our listeners, thank you for tuning into Compound Insights from CFA Society New York. I'm Gary Farber, and we look forward to bringing you more conversations with leading voices in finance. Leading a financial service firm requires a distinct approach to strategy and leadership. That's why Harvard Business School Executive Education offers a 5-day in-person program focused on leading professional service firms. In this program, participants like you will explore topics such as corporate culture, retaining talent, and communicating a strategy and vision. By the end of the program, participants will gain frameworks to lead change while preserving client satisfaction. Explore the program at hbs.me/client. That's hbs.me/client.